Forex Focus brought to you by IG, taking a look at the current state of inflation. If inflation can cause a US dollar crash, what that would even look like. How does inflation affect the US dollar? What does it all mean? And moving forward, given our current environment where inflation's still high, but descending, what should you be afraid of? Should you be afraid of high inflation? Should you be afraid of deflation as a holder of US dollars? And where might USD-based pairs be headed depending on that inflation data? Because we have our first inflation rate of the year coming out of the US here this week. And they come out every month. There's the CPI and there's the PCE, which is the latter is a less prominent one in terms of causing market fluctuations, but the Fed loves monitoring that, and we'll get to the Fed in just a second. But those are the two main inflation rates that are quoted for the U.S. economy. And what is an inflation rate? Well, it's a measure of the change in prices for a basket of goods and services that affects the value of your currency relative to those goods and services. And so if the inflation rate is positive, that is inflation, and that is saying that the price of goods and services per unit of currency is increasing. And if that inflation rate is negative, can be negative, and has been several times historically, as we'll get to in a second, that is deflation. And that's saying that this basket of goods and services, that the CPI or PCE, they have their own distinct baskets of goods and services that include all kinds of everyday items and also can include food and energy and all these different things. If it's negative, the prices for goods and services are decreasing per unit of currency. And that might seem like a good thing, but it's a lot more nuanced. Both sides of this equation are a lot more nuanced, as we'll get to here in a second. But we are going to, of course, focus on inflation. The economy is historically usually in an inflationary period where the inflation rate is positive. We'll show that in just a second. And that's for good reason. The effects of inflation are actually kind of good, or at least, and this is one of those things similar to options traders and volatility. Something that you learn very early in options trading, just as a quick aside, as an example, is options prices and volatility move in tandem. Same with, I should say, even bond prices and interest rates, right? If you have someone that tells you, interest rates are higher because bond prices have moved lower, or one has caused the other, it's the same beast. And same with the economy and inflation. One doesn't necessarily cause the other, but they happen together. And the effects of inflation include, yes, goods and services costing more per unit of currency, which sounds like a bad thing. If I have $100 in 2024 and there's a 2% inflation rate between 2024 and 2025, and in 25 I just have the same $100, well, everything costs 2% more now. That sucks. That's not great. But what we've seen over the course of the last several decades, and what economists have come to as not necessarily a resolution. We've never solved the economy. It's continuing to grow always, but from what they could tell, a 2 to 4% rate of inflation, and essentially anything around that 2% is the target. It shows that the economy is growing, and that's usually happening. That's what we would call a normal inflation. That's usually happening along with wages growing. And so the idea would be, okay, I've got $100 this year, and over the course of the next year, there's a 2% inflation rate, and goods and services have gotten more expensive, but also Apple is promoting better products, and all of those products are driving a bunch of different sectors as well. Not only the sectors that go into making an iPhone, but also the sectors that use iPhones for a bunch of different things. All of the different technology companies that have applications on iPhones, all of the different, any company, financial companies, communications companies that use iPhones for whatever. You catch my drift here. That with that 2% inflation rate, you're likely getting wages or salaries that are increasing by hopefully 2, 3, 4%, slightly higher. Now, when we get inflation that's 4, 5, 6, 10%, we're starting to talk about hyperinflation, which becomes a problem very quickly. And so absolutely something to monitor, but there you have kind of the general effects and the general measures. And then finally, yeah, low inflation or deflation. While it might seem like theoretically a great thing, I got $100 this year, I could have $100 next year, and everything fell by 2% in price or 5% or 10%. That's great. Deflation must be great. Along with that comes a lot of employment problems. Usually unemployment is high when we're seeing deflation. Usually you're in the midst of a stock market crash when you're seeing deflation. Those prices for goods and services are falling in tandem with usually some bad economic activity. So careful what you wish for on that deflation front. And here you have the last 100 years of inflation rates from our friends at Trading Economics, and they're sourcing from the U.S. Bureau of Labor Statistics. And you can see that the mean, the average, the normal state is around 2%. We've hit it a lot. We've fluctuated around it and usually come back to around that 2%. And that is what the central bank, the Fed, here in the U.S., will tell you that's what they're looking for is 2% inflation. And if they have 1% or 0% or negative deflation, they're looking to get that higher, and they're usually going to be reducing interest rates or committing growth initiatives, quantitative easing, to get that inflation rate up and get the economy kick-started. And if it's higher than 2%, if it's 3, 4, 5, 6, like I say, up to 10%, it's been 15 to 20% in the 40s and 50s at certain periods, and even as recently as the 80s, it's been north of 10%. Then they're usually increasing interest rates, going into contractionary mode, trying to reel that economy in, so that at that point you're needing 10, 15, 20% raises to account for the growth in prices for goods and services. And just wanted to quickly highlight some of the low points in inflation, because we are going to be focusing on high inflation here and what that might do to the US dollar in just a second. But it is worth noting that, again, the most deflationary periods were in tandem with the Great Depression and the financial crisis. So again, deflation, I'd rather have slightly high inflation than deflation. The economists and theoreticians would probably agree. But of course, the market does what it wants to do. And the current market has been showing high inflation. That's been the recent problem. In 2022, U.S. inflation actually got up to 9%. And you'll probably remember in the middle part to end of 2022, stocks were getting beat up pretty bad. And I think there was a general fear across the U.S. and globally of this inflation problem getting out of hand. We had the pandemic crash, and the economy slowed down, obviously, in March and April and May. And then we saw a huge bounce back in the stock market and majority of the economy. And that actually brought with it so much growth that inflation got super high and peaked at around 9% in 2022. But as you can see, it's actually been stair-stepping lower for most months of the last year and a half, 2 years almost. And that brings us to our current environment, which is very nuanced. Now we're going to start talking about this effect on the US dollar. And to do that, I have to bring in interest rates, because that has maybe an even more effect or direct effect than inflation. It might be, inflation affects interest rates, and interest rates can really affect dollars. And you can see we saw higher interest rates in this same period. You have the 10-year interest rate in black. No coincidence that throughout 2021 and 2022, and even into 2023, interest rates were rising as inflation did rise and then peaked and moved lower. The Fed in that time hiked from 0% in 2022, the start of 2022, 0% interest rates to over 5% by the end of 2023. And now bringing that dollar piece into it, the dollar saw great strength compared to Japanese yen and compared to euro at various points, and the pound, which might seem kind of kooky, right? It's like, well, if inflation's 9%, and you're telling me that my US dollar can buy me not so many goods and services are now 9% more expensive compared to my US dollar than they were last year. But like I say, that middleman of interest rates moving really high here in the US, much higher. Japan never hiked interest rates, and they moved higher than the euro area and then the UK, then in Australia and Canada as well. That actually translated to relative strength between the dollar and those other currencies, because as you can see here, the dollar has a lot of nuanced relationships. And while it may be weakened compared to US goods and services, it actually strengthened compared to Japanese yen, euro, pound, Australian dollar, and Canadian dollar, because that interest rate piece, that middleman, and that's what you really have to watch here, is the relative performance of interest rates is a key driver for these dollar relationships looking outside of just the US. When you're talking about forex trading, how inflation is affecting US interest rates versus Japanese interest rates versus euro interest rates and everything else, that's going to be a more direct translation into those forex markets. And so, we're going to watch this US inflation rate come out, and it'll be meaningful for the US dollar and US interest rates. But what you almost want to watch is the relative performance of US inflation to these other global entities like Canada here in North America, or like the euro area, or the UK, or even, Japan has seen some sparks in inflation. Because what's been driving some of the currency depreciation is fear of not only stair-stepping down to 2% inflation here in the US, but what if the US goes to deflation and, for example, the euro area stays at 2 or 3 or 4% inflation, and the US has to cut interest rates all the way down to 0%, but the euro area stays at 3 or 4%, you might see that dollar really crash compared to the euro. And that's just an example, obviously, but it's one that could, one, be flipped on its head, but two, lend itself to any of the major currency pairs, because you look at the euro versus the dollar over the course, the same time frame that we just looked at for the dollar versus the yen. And like I say, the dollar saw great strength. I mean, it got down to below parity against the euro, some of the strongest dollar price action we've seen in the last 20 years. But it has been a little bit more complex, more nuanced, and right now is sitting at $1.10 per euro, which is off of its lows of being close to parity, and now could potentially get back to 120 or could resurge again. So will inflation cause this US dollar crash? We'll see. We're going to be monitoring relative inflation rates and those interest rates as well.